This video covers Chapter 4. It covers a category called order types. I'll be discussing market orders, limit orders, stop orders, and also what a limit order book represents. I'm following Chapter 4 notes, which are on Blackboard. So I'm on page two of my notes, and we got to get some preliminary concepts and terms out of the way before we actually get into various order types. And the first concept is bid and ask prices. Bid-ask spread is the first concept. And so we've covered this before. And a bid price is from the dealer's perspective, so I'm always looking at it from a dealer's perspective, it's the price the dealer wants to pay. Okay? And the asking price is sometimes called the offering price, and it's the price at which the dealer wants to sell at. So the difference will be the dealer's profit. And so you could have, a stock for $14. That would be the bid. That's a dealer would be willing to buy it at $14. But the dealer needs to make a profit that's going to cover their costs and risk involved in carrying that inventory of stocks. So they might charge $14.03 for this stock. Now, the spread is 3 cents. Okay, 3 cents. And the way it's usually looked at in the market is that if you were to buy stock, you'd have to pay $14.03. If you wanted to immediately sell it, you'd have to sell it for $14 for a 3 cent loss. It would be the dealer's gain, right, at 3 cents. And most people don't buy and sell immediately. That wouldn't make sense, obviously, if you lose 3 cents. So when you buy, most people look at this spread, this implicit cost in trading, and that's what we're dealing with. An implicit cost you really can't see for the most part, as being half of the 3 cents, meaning it's 1.5 cents is basically the spread that you're paying when you either buy at the dealer's asking or you sell at the dealer's bid price. So when you execute one leg of a transaction, and when I say a leg of a transaction, it's one side of a transaction, either the buy or a sell, then you're basically implicitly paying 1.5 cents in this example in terms of a spread. Okay, let's look at transaction execution costs. There are other costs for transacting with stocks, and they're not directly observable either, besides bid-ask spread. These are, for example, price impact costs. And price impact costs have to do with adverse movements in in price that one would encounter when making a trade. It usually happens when you're dealing with a stock where you want to unload, for example, buy or sell. But let's use an example. You're trying to unload 1 million shares of a small company stock. Now, if you try to sell 1 million shares of a small company stock, the stock probably doesn't trade that much in a given day. The volume is probably low. And if an order comes through to sell 1 million shares, you're going to panic the market. And what's going to happen is people in the market are going to think, wow, there's a big trader making a trade out there, and this person must have information that I don't have. And so they're going to sell everything they have and ask questions later. And so there's going to be panic. So in order to reduce price impact, what you do is you'd give this order of 1 million shares to a trader who specializes in allocating the trade over a couple of days or maybe even a week to reduce the price impact costs. And even if you didn't get panic in the markets, whenever you sell a stock, you're putting downward pressure on the stock. Whenever you buy a stock, you're putting upward pressure on it. If you have a highly liquid stock, that upward pressure is so small you won't detect it. You'll detect it as the shares that you want to trade are large in proportion to the volume that goes on and the depth of the market. Okay? So this concept of price impact also works on the buy side. So if you want to buy 1 million shares of a stock that's hardly traded, you're going to push the price up, up, up. And so probably the way to go is to ask your trader to buy this stock over a period of time, and you'll lessen the price impact. But as I said, price impact, it's always there. But if you manage to transact large transactions properly, you'll reduce that price impact. Okay, so keep that in mind. Another term that you're going to want to know about is call options, and also put options. Now, this is not a derivatives class. It's not financial engineering. But understanding what a call option and a put option, just in its basic form, will be helpful in understanding these order types. It'll give you a little more insight than what the book is telling you. So a call option gives the holder the right to buy, but not the obligation to buy. Okay? In other words, it's an option to buy a stock at a certain price, and that certain price is called either the strike or the exercise price. It means the same thing. During a certain period, and that period of time is the time to maturity. So if you hold and own a call option, you're bullish on the stock, because what you want to happen is you want the stock to appreciate greatly in value, because that exercise or strike price stays fixed. Employee stock options are a nice example of a call option. Employee stock options are not traded options, but nevertheless they are options that are given to employees. And usually the strike price is fixed around about where the market value of the stock is at present. So, if you have if your company stock is trading at $17 a share, they issue employee stock options to you, the strike price will probably be about $17. And if the stock goes up in value, you're going to be happy, because you have the right to buy shares at $17 when the stock is trading in the open market at a much higher price. So employee stock options are a way to get management to align management's goals with the company. And so if the company does well, the stock does well, and the management will be better off. And so it aligns their management's goals there. Okay, so when you buy a call option, you're bullish. Now, keep in mind with both calls and put options is that they're not always explicit. Sometimes you got call and put options. They're in specific transactions, but they're not separated out, and so they're embedded calls and put options, as we'll see a little later. Okay, let's define a put. A put is kind of the opposite of a call, and a put option gives the holder, the person who owns the put, the right but not the obligation to sell a stock at a certain price, known as the expiration or known as the exercise price or the strike, during a certain period of time, known as the maturity. So with both calls and puts, I forgot to mention this with the call, but you pay a premium. And when you buy puts and calls on an exchange like the Chicago Board of Options Exchange, you pay an explicit premium for that right to buy, which is a call option. You'll pay a specific premium for the right to sell at an exercise price. That's what a put option is about. Now, if you end up with implicit calls and puts, as we'll see a little later on, the premium is not explicit. You won't actually see it. Examples of what would be like an implicit call option, for example. Well, or an implicit option would be frequent flyer miles or coupons, where you have the ability to exercise at a certain price and get a discount on a commodity, on a good. Let's see here. Let's talk about liquidity now. Liquidity is the ability to trade when you want to trade. The concept of liquidity is multidimensional. It depends on the person you're talking to, basically, and how they're defining liquidity. But in general, it has to do with the ease and speed at which you can sell a security while maintaining price continuity, meaning you don't have to drop the price significantly in order to sell it, and you don't have to, the price of the stock won't drive up significantly if you try to buy it. So liquidity is the ease and speed at which you can buy or sell an asset with price continuity, meaning the price doesn't jump either up or down significantly. That term will pop up a lot in the class. People measure liquidity through, for example, the volume. If you got a heavy volume security, like Apple, for example, General Electric, gigantic companies, millions and millions of shares trade a day. If you wanted to buy or sell 100 shares, that market is so liquid that you're barely going to move the price. There'll be almost no price impact, and you'll be able to execute your trade really fast. If you went into a small company that hardly anybody knows and you wanted to trade, 10,000 shares, that may be another story. That stock may not be that very liquid, and then you're going to have impact costs, which means you do not have price continuity. Okay, with these terms in mind, let's jump over to order types. First order type we want to discuss is a market order, which is by far the most common order. Market. Okay. That's what I initially do in StockTrack. I expect you to place market orders. So a market order is an order to buy or sell at the next best available price. When you place an order with your broker is required to get you the next best available price for that stock. And I'm going to use stock as an example. This concept of bid-ask spreads, price impact, price continuity, liquidity, it applies to options, futures contracts, commodities, currencies, bonds. I'm going to use stocks as an example in all of this chapter. It's just easier. So a market order is the next best available price, and your broker is responsible and required to get you the next best available price. And here's what I mean by that. Your broker, when you submit an order, your broker is required to scour the world, not the world, but to scour the market in general, meaning looking at various dealers in that security. So if you wanted to buy Apple stock from a broker, your broker will have access to maybe a dozen or more dealers in Apple stock. And each dealer is going to have a separate bid and a separate ask price for Apple stock. And so your broker is required to pick the one with the best deal, so to speak, for your order, given the size of your order and how you want to execute it. So that's a market order, and that's how it works. Now, when markets get volatile and there's uncertainty in the market, what happens is there's the bid-ask spread starts to widen, and execution price uncertainty starts to increase. What I mean by that is you don't know exactly what price you're going to get. So look at the definition of a market order. It says in order to buy at the next best available price or to sell at the next best available price. There's no specified price there. So your broker is going to execute this transaction, but you really don't know what price you're going to be buying or selling that stock at. So it leads to price uncertainty on your part. And when the market is quite volatile, you just increase that uncertainty even more. So when that happens, right, it leads people to want to get rid of that uncertainty. And that leads us into what are called limit orders. Limit orders are designed to get rid of price uncertainty. Okay? So a limit order is an order to buy or sell at a specific price or better. And that's the important point, or better. If you're buying, or better means a low price. And if you're selling, or better means a higher price. Now, the problem with a limit order is, whether you're buying or selling, the limit order may never happen. The execution may never happen because the stock may never become or better. So you'll get the price you want if the price is hit. Okay? So you got price certainty but execution uncertainty with a limit order. Whereas with a market order, you have price uncertainty but execution certainty. By execution certainty with a market order, what I mean is the order will be processed. You just don't know what price it'll be at. So, an example. So let's compare and contrast market and limit orders. Okay, so let's say you see a stock right now. It's sitting at $22 a share. Okay, now if you put a market order in and you observe on your screen that the stock price is 22, you put a market order in, you'll get that stock for sure. It could be a little bit above, it could be at, or it could be a little bit below $22. Keep in mind, and this is, many students fail to realize this, that you're not the only person in the market trading. There's probably 100 people around trying to get transactions executed at around $22. There's lots of transactions at any point in time. I mean, think about it. When you got these stocks like Apple and General Electric that trade millions and millions of shares, in any one given minute, there could be 100,000 or more shares trading. There could be a dozen trades in a couple of seconds, or more, 100 trades in a second. So keep that in mind. So you think, you're like, oh, the stock's at 22, I'm going to get the stock at 22. Somebody could sneak in there and push the price up or push the price down in a sell transaction. Between the time you pull the trigger and the time the trade actually gets executed. Okay, so that's a market order. It's going to be slightly above, slightly below, or at 22. With a limit order now, with a standard limit order now, this is a standard limit order, you would say, this is how it would work. You'd say, you know, I don't want to buy the stock. So the stock right now is at 22, and you put a limit order for $20 a share. What you're saying is, the stock's too expensive right now. I don't want to buy it unless it drops to $20 or less per share, and then I'll buy it. Okay, so keep in mind when you place a limit order, and in StockTrack you'll see this. You place a limit order, you circle the little dot that says limit here, or you fill in limit, you tell the box, you say limit. It opens up another window right next to it. And why is that other window there? The other window means you have to set a price in there. Okay, so when you click on a limit order in StockTrack, it's going to open up a window and it's going to ask you what price, and you're going to have to fill the price in. And then it'll fill in, there could be another box even to the right of that, and it's going to ask, well, how long do you want this order to be there for? Do you want it good for the day? Or good till you decide to cancel, and so on. So it'll drop down a drop-down menu here that'll ask you the additional information as how long do you want this order for. With a market order, you click market order in StockTrack or any broker's account. There's no little window. The window doesn't show up because you don't put the price in. The broker's going to come back and tell you what the price was executed at. Okay. So now, with a standard limit order buy, standard limit buy, the price is going to be less than the market price. The limit price that you specify, in this case $20, is going to be less than the current market price. If you put a limit sell in, it's going to have to be higher. So you could put a limit sell at 23, for example, and here you're saying, you know, I think the stock's going to go up, and I'm not going to sell it for anything less than $23 a share, in which case you're going to have to wait for the stock to go up to 23, and then your broker is going to execute that transaction. So with the sell order, the limit price is set above the current market price that you observe. So those are standard limit order examples. So notice that you specify a price, and if that price is hit, you're going to get the stock for that transaction at that price. But you get execution uncertainty because the stock, if you're selling it, may never go up to 23. If you're buying it, may never drop to 20. In which case, if it's sitting in this area, it doesn't get executed. And that could be the case. It may never get executed. There are, by the way, types of orders called a marketable limit order. And a marketable limit order is such that the order right now is already in play. and will be executed most likely. Here's what I mean by that. Let's say the stock is at $22 a share right now. You observe it. So you see it. I'll put C. I don't want to use market too much. So I'll just say, instead of observing a market order, you see the order. Right now it's on your screen. You observe it. It's at $22 a share. You could reduce your risk if you really want this stock and say, look, I want to buy the stock, but I'm nervous because the stock is gyrating. It's doing this on me. And you observe the stock right now. It's at 22. But the darn thing could be way up or it could be way down. So what you could say is, look, I'm happy with the price of 22. Or maybe, I'm even willing to pay a little bit more. Maybe I'm willing to pay 22 and a quarter, let's say. But I'm not willing to pay any more than that. I don't want to pay up here. I don't want that to happen. So what you can do is you can put what's called a marketable limit order in. What a marketable limit order means is that it has the ability to be executed now. But it limits your risk. Remember, with a market order, if you put a market order in at 22, you could end up paying $30 a share. If somebody comes in and puts in an order for 10 million shares, drives the price up between now and the second you pull the trigger, and by the time it's executed, the price is at 30. You're going to be paying $30 a share. If you want to avoid that risk, and it could be when markets are highly volatile, you could put a marketable limit order in, which says, I'm willing to pay a little bit more than 22, up to say 22 and a quarter, right? And so I will get the stock at 22 and a quarter or less. And that would be a marketable limit buy. You could also do a marketable limit sell. So if the stock, you see or observe the stock at 22, you could say, look, I know the market's really volatile in this stock. It's gyrating. I'll sell it for $21 or more. Okay, 21 or more. And so you place that order in. The chances are it will be executed, but given the market's quite volatile, it's possible it doesn't get executed, but it's a good chance it will, because your order, the price is already, as you observe, already or better in this case. And so that would be a marketable limit sell order. Okay. Now, limit orders are implicit options to trade. Okay, limit buy orders are implicitly put options. Now, they're put options to the other traders, that you're basically giving them put options. So when you specify a limit order and the limit buy, and the order is not executed, it's not a marketable limit order, then there's traders out there that see that order posted. They know that order exists, and it's basically a put option because that gives them the right to sell at the limit price that you're specifying. And so also on the other side of things now, limit sell orders are implicitly call options to other traders to buy the stock that you're trying to sell at the limit price. So keep that in mind. When you put limit orders in, you're supplying liquidity to the market because it's making it other traders easier to trade. You're making it easier on them. Okay. Now, limit orders versus exchange traded options. I won't spend much time on this, but some people see a relationship or a correspondence between for example, a limit buy order and an in-the-money call option. They think, okay, a limit buy order specifies a certain price, and if it gets reached, I'll get to buy it. And they look at that limit order price as being like the exercise price on a call option. However, keep in mind the two are different. With options, you pay a premium, and you get to hold that option for the entire life of the option. And it doesn't matter where the stock goes, you still have the ability to exercise it if it's in the money. But with a limit buy order, for example, once that limit buy goes over that, once that price gets triggered at that limit price, hits that price, the order will be executed, and so it's automatic. But with options, you can time when you want to exercise that option. So there are differences between limit buys, limit sells, and call and put options. Let's look at the third type of option. Third type of option is stop orders. Stop orders is an order to buy or sell at a certain price, or possibly worse or better. Now, what do I mean by that? Well, a stop order, when you place a stop order in Stock Tracker, let me write this down here. Place a stop order with Stock Tracker or your broker. You specify stop. That's one place. It's going to pop open another window, and that window is you need to specify a stop price. So maybe you specify, I want to buy this, I want to buy or sell this stock at $40. And so that's the stop price. The stop price is a trigger price. And what it triggers is when the market actually reaches $40 a share, it triggers a market order. So when you put a stop buy order in and the market hits $40, it's going to trigger a market order, which means you're right back to square one with market orders. And it means you don't quite know what price you're going to buy or sell the stock at because it's a market order now. And so you know for sure the order will be executed once the market hits 40, but you don't really know what price you're getting. Stop orders are designed to reduce risk in a stock, to stop losses, for example. So as an example, of a stop buy, you might have to twist your brain a little bit on this one, but let's say you short sell a stock at $37 a share. That means short sell a stock, and I'm going to cover this in a later video covering in this chapter 4. Short selling stock means, look, you're bearish on the stock, you expect it to drop in value, so you borrow shares from your broker and sell the shares for $37 a share. And you hope to buy it back at a later date at a lower price. So you sell first and buy it later. But you sell high and you want to buy low. So you're hoping maybe it goes to $30 a share. And so you would have sold it for $37, bought it at $30, you'd make a capital gain of $7 in a declining market. That's what it's designed to do, make money in a declining market. But let's say things go against you. And what I mean by that is when you short a stock, you want it to drop. But going against you means what happens if the stock starts to go up? Whoa, there's no ceiling on a stock. There's a floor on a stock. If you buy a stock at 37, if you buy it, it could drop to zero. That's the most you can lose is $37. But when you short a stock, there is no ceiling on a stock. It could go like a rocket, theoretically, to infinity. So you have unlimited risk associated with short selling. So when you short sell, what you want to do to limit your risk is you want to put a stop loss order in. So if I put a stop loss at 40, what that means is when the market hits 40, it's going to trigger a market order to buy this stock. In other words, cover the short sale. Buy the stock at approximately $40, because once that trigger of $40 gets hit, it's basically a market order, which means at 40, above, or slightly less than 40. And so you can use your imagination to what a stop loss sell order would be. The market's dropping. The market could be dropping. If you buy a stock and you own that stock and it drops, you could put a stop loss sell at it at a price below where the current market price is to prevent and stop any more losses. And again, it would be, the stop price that you put in it is a trigger that triggers a market order.